Hey, good morning, everybody. This is Ryan Moe filling in for Joe Vaklovic, who is on vacation still. He will be back on Monday, and I'm sure he's looking forward to getting back. We have grains a little bit lower this morning. July corn is off 2.5, and Dece corn is off about 2 3/4. November soybeans down 3 1/4, with the wheat markets just slightly unchanged here, down about a penny. Minneapolis wheat seems to be the only one that wants to win out there today, and it's only up a penny and 3/4, with Dece Kansas City wheat down about a penny and a half. We did get some relaxation in the energy markets here with crude oil up 50 cents. That's probably a great place for us to go ahead and kick off the latest news wires.
So the truce between Israel and Iran remains intact, with the ceasefire holding through the night. There were fears that Iran might close the Strait of Hormuz, a move that could severely disrupt global oil flows. However, such an action would have disproportionately hurt its key ally, China. Instead, Iran opted for a symbolic and pre-announced strike on the Qatar base, aiming to send a message without triggering broader fallout.
This article by the Financial Times was absolutely fantastic. And if you guys get a chance to read it, I strongly recommend that you do. If you have a subscription to it, it might even be on one of the free services. When we look at what the traders are saying about what took place, they were talking about how it was so well orchestrated and so well communicated that they, I don't want to say knew it was coming, but they knew that the impacts were not going to negatively impact the infrastructure. And when we talk about infrastructure, that is the Straits of Hormuz. And that is about a 2 mile channel that most of the Middle Eastern crude oil that flows to the world goes through. And if that were to ever get disrupted, that would create some very significant problems. When we look at where Iran's oil story has been over the last several years, I found it very challenging yesterday when I was going out and doing research on this, because I couldn't find anything that wasn't really politically charged. And that was really quite frustrating to me. But when we look at what has happened to Iran's oil flows over the last several years, we see that they were really ramping up. And we see that there was definitely some challenges because of the number of sanctions that they'd been under. But we had seen an increase in those oil flows. However, those oil flows were going in much different places in 2023, which is the latest news I could find, versus where they were going in 2017. If you look at the slide here, you can see that before the sanctions hit, only 26% of their crude oil went to China. After the sanctions hit here, and then in the most recent data in 2023, it shows us that about 91% of their crude oil is going to China. So China is going to be significantly impacted by any amount of energy infrastructure damage that's done to Iran. And I think that's very important to know that Iran wants to have China as an ally in the future.
Moving forward, July corn futures hit life of contract lows as the sell off extended into Tuesday. After breaking the previous low from August 2024 on Monday, prices continued to slide. With first notice day approaching on Friday, most trading volume on the Chicago Board of Trade has shifted to the September and December contracts. While many hedge funds have already ruled their positions, open interest in July remains near 200,000 contracts, indicating that the weakness isn't simply due to a lack of liquidity. The July September spread remains inverted, but some in the Eastern Corn Belt cash trade believe it could flip to a carry, especially if fund selling continues and commercial bushels keep both domestic and export markets well supplied.
Yeah, this is why we put a rusty slide in the initial headline. It's been pretty ugly here for July corn. There's been a lot of really rough news that has hit it. Also, you see that the July corn, because the hedge funds tend to trade so much in the front month up until about a week or so ago, that was the contract that was hardest hit, even though the July corn contract isn't necessarily the new crop corn contract, which is the crop that's growing in the field right now, which appears to be in pretty darn good shape. The July corn has been hit the hardest. And as these new lows keep coming at us, it just goes to show that we have a lot of corn coming our way and a lot of corn in the world due to a Brazilian crop as well. So, Mackenzie, what do we have up next?
According to consulting firm AgroConsult, Brazil is expected to produce a record large second corn crop. Production is estimated at 123.3 million metric tons, accounting for roughly 80% of the country's total corn output this year. The estimate is 9.2% higher than the firm's May forecast and nearly 20% above last season's production. Favorable weather conditions, particularly abundant rainfall in April and May across key growing regions, have contributed to the bumper crop. In Mato Grosso, yields are expected to rise nearly 12% from last year. That being said, there are growing concerns that the record crop could further pressure already weak domestic corn prices, while sluggish export demand adds to the bearish outlook.
There's a lot of corn and only so many homes for it. When you see what's happening down in Brazil, and when you see the crop transitions that are taking place, and when you see what is really in the mindset of the farmer down there, the double cropping of corn and soybeans is only going to continue to grow. I'm pulling up a chart here from our group down in our market intelligence group down in Brazil. I mean, they've even got some that are putting out a third crop of corn, which is unbelievable, but still something that is being done down there, because if there's profit in it, they're going to farm it. And when we see their production potential, it just leads us even more down the path that what we need is more and more demand. And that demand came to us here in the United States in the form of a flash sale yesterday, which was great to see.
Yeah, so U.S. exporters sold 25 million bushels of corn to Mexico. Of the total, 22 million bushels are for delivery during the 25-26 marketing year, and 3 million bushels are for delivery during the 26-27 marketing year.
Fantastic news. We're really glad that the United States was able to grab this sale. As you saw in the chart before, there's a lot of corn in the world, and there is potential for some of that corn to make its way to Mexico, which would be a pretty significant ding to one of our greatest trading partners. And so the fact that we are still grabbing these sales out of Mexico, and some of these are for next year, in fact, this is good news for us on many, many fronts.
Soybean oil has traded down to levels where chart gaps were created during the recent biofuels guidance rally. Prices have come under pressure, weighed down by diesel futures, which have dropped more than 40 cents since Sunday night. Technical traders often follow the rule that all open chart gaps should eventually be filled. In this case, many are watching for the most actively traded December contract to decline to the June 13 high of 51.19 to close that gap. A smaller gap also remains between Monday and Tuesday night's trade between 53.46 and 53.62. Bulls would prefer to see these gaps filled quickly. Traders positioning around nearby gaps typically use tight stop losses to protect against a sharp move aimed at filling the gap.
This audience is extremely fortunate to have access to Brian Splitt. He's forgotten more about technical trading than I will ever know. But what he will tell you is probably the same thing that many traders that have been trading technicals for a very long time, which is all open chart gaps get filled. And when we look at that gap that was left by the euphoric news coming out of DC on the biofuels suggestions, I don't want to call them mandates, we'll call them guidelines as they are sitting today. That was great news, and that market gapped higher after already a significantly large move higher the day before. Leaving that gap, though, is problematic for many in the trade, because until that gap is filled, it doesn't feel like the bulls are going to be able to make another run at new highs. If we could get this gap filled sooner than later, I'm sure there's going to be many in the trade that would like to go ahead and see that, even though we might have to go through a little bit of pain in order to get to the gain. But in order to get to the stuff that people really want to hear about, which is the weather, what did our friends at Crop Profit been saying?
Weather forecasts remain non-threatening, with outlooks now extending into early July. Both the Euro and GFS models have scaled back some of the precipitation seen in earlier runs. With July 1st just a week away, the 6 to 10 day forecasts call for warm temperatures balanced by ample rainfall. Crop profits 15-day outlooks appear generally favorable for corn and soybean production compared to the USDA's projections. However, corn is slightly negative relative to their independent forecasts, largely due to last week's decline in crop ratings. For soybeans, the outlook is slightly supportive, with much of the beneficial weather expected across the upper Midwest.
This is a great series of maps to look at, strictly from the standpoint of you have to look at what's taking place all over the country so that you get out of your backyard mindset. It's very common for people to want to trade what's going on in their backyard. And if I were to be trading what was going on in my backyard, which is central Minnesota on down into central Iowa, I would be seeing that, hey, we've had a good amount of rainfall, and I would just make the assumption that everybody else has received the same level of rainfall. What these maps are going to show us is that it's been warmer and drier than what we were actually expecting. When you see here with the previous 30 days, you see that we didn't get as much rain in certain parts of the Corn Belt where it was assumed that there was more rain that was actually falling than was. Also, with the heat that's been coming up there, as you see in the bottom right-hand corner there, we are getting excess heat, not by a lot, but just by enough to go ahead and make things a little bit more concerning than what I would have otherwise assumed by trading what was going on in my backyard. And when we look at where the forecast is going to be for the next 14 days, we are seeing that we're going to see quite a bit more heat, which last weekend the heat was good. But are we going to get too much of a good thing? We are expected to get a fair amount of precipitation to go along with this heat, which I think is going to make for probably a hot and sticky 4th of July. But if we don't get this precipitation and we do get the heat, there could be some setbacks to this corn crop that is otherwise in very good shape. Moving on from the weather, what's happening over there in the livestock markets?
Cattle futures were mostly lower on Tuesday. Live cattle were 15 cents to 70 cents lower, with the exception of the August 25 contract gaining 17 cents. Feeders saw losses of 2 cents, down 55 cents, with the exception of the March 26 contract that gained a mere 2 cents. Choice box beef once again posted a new high for the year on Tuesday as it gained 403 at 394.25. Select lost 69 cents at 382.41.
Wow. New high after new high after new high, huh?
Yep, things are moving.
What a rocket. Very good, everybody. Thanks very much, and have yourselves a great day.